Welcome back to The Explainer. Today, we're diving straight into a fascinating and, honestly, a pretty jarring clash happening right now in our modern financial system. On one hand, you've got us, right? Everyday retail investors quietly sticking to our disciplined saving and accumulation plans. And on the other hand, the highly privileged, behind-closed-doors access of powerful political figures. We're going to unpack the nuts and bolts of what's being called insider capitalism. It's a system that literally pits the overwhelming advantage of the powerful against the patience of the everyday saver.
So here's our roadmap for this explainer. First up, the Dell paradox. Then, the ethical boundary of investing, the three pillars of insider capitalism, a look at historical precedents, how all this impacts trust in our financial system, and finally, patience capitalism. I promise you a purely data-driven, objective look at how modern wealth accumulation actually works at the absolute highest levels.
All right, Section 1, the Dell paradox.
So let's bring this massive economic theory down to earth. Picture this, we're in Washington. A prominent political figure, in this specific case, Donald Trump during his presidency, steps up to a podium, thanks the Dell family, and tells the cameras point blank, "Go buy Dell, they are fantastic." Well, as you'd expect, everyday savers instantly rush to their brokerage accounts. I mean, they're convinced they just got a golden tip directly from the President of the United States. And the market? It reacts exactly how you'd think. In a single day, Dell's stock shoots up between 12 and 15%. Boom.
But here is where things get really interesting. Let's look at the timeline before that announcement. If you dig into the official publicly filed financial disclosure forms, millions of dollars in Dell stock were actually purchased by this figure in the exact weeks leading up to that very public endorsement. We're talking purchases on February 10th, March 2nd, March 11th, and March 23rd. All of that adds up to $5 million, or maybe even more. Think about that. The most powerful person on the planet tells you exactly what to buy, literally the day after he finished buying it himself. Which brings us to Section 2, the ethical boundary of investing.
Now, this brings up a really uncomfortable question. Where exactly is the line between brilliant market timing, informed investing, and just having an unfair advantage? If you or I worked at a regular corporation and used non-public knowledge to make a trade, well, that's insider trading. But at the highest levels of politics, that line gets incredibly blurry. Look at these numbers. A genuinely skilled professional trader, someone who literally does this for a living, usually hits a success rate of around 51 to 52%. But when analysts at a monitoring service called Unusual Whales looked at the precision of certain trades connected to political events, they found an unbelievable success rate of around 93% for politically connected figures.
93%. Let's just pause on that statistical anomaly for a second. In finance, a number like that just shouldn't exist for a normal person. Now, I want to be absolutely clear and perfectly impartial here. This is just a data correlation for us to analyze. It is not a legal condemnation, and nobody's been prosecuted for this specific data point. We're not here to play judge and jury. But we do need to recognize that this isn't just one person getting wildly lucky. This points to an entire structural system operating behind the scenes.
And honestly, the sheer volume of these trades is just staggering. Take a look at official form OG-278T, which was filed in the first quarter of his term. There were over 3,800 stock market transactions. We're talking massive blocks of $5, $10, even $25 million in companies like Nvidia, Apple, and Microsoft. Now contrast that hyperactivity with an average retail investor. Someone spending an hour just trying to decide between a Vanguard or an MSCI World ETF for their simple $300 monthly deposit. This political figure was closing more trades than a professional hedge fund manager, all while running a country.
All right, Section 3, the three pillars of insider capitalism.
So how do we actually make sense of all this? Let's zoom out a bit. The Economist, which, as you know, is one of the most respected financial publications out there, coined a term for this. They call it insider capitalism, or access capitalism. It's an economic system where the biggest rewards don't come from individual merit anymore, but from privileged access and early information. It totally flips the comforting idea that modern financial markets are perfectly democratized. We're always told that crypto and trading apps leveled the playing field, right? Well, insider capitalism argues the exact opposite. As markets open up to the public, the premium on having inside access actually skyrockets.
The Economist breaks this system down into three structural pillars. First, earning immense wealth actively while governing. Second, selling access and influence to corporations, where the line between a politician's personal portfolio and national corporate interest just kind of vanishes. And third, leveraging inside information on these subtly exploding new prediction markets. Let's dig into that first pillar with some objective data on wealth generated during an active presidency. And to keep things completely impartial, we're looking at two separate, highly respected estimates. On one hand, the New York Times took a fairly conservative approach, estimating $1.4 billion generated over the term. On the other hand, the New Yorker looked at the whole shebang, club memberships, merchandising, crypto, and estimated $3.4 billion. But here's the crucial takeaway. Regardless of which accounting method you prefer, we are looking at over $1 billion constructed during an active term in office. Moving on to Section 4, Historical Precedents Compared. Now, you might be thinking, hey, don't all presidents make a ton of money? And yeah, it's a fair question. But look at this comparison, because the timing of this wealth accumulation has fundamentally shifted. Historically, folks like Bill Clinton or Barack Obama entered the White House with relatively modest wealth, around $1 million or so, and left to make tens or hundreds of millions. But that happened after their presidency, right? It was book deals, speeches, talk shows. The modern trend of insider capitalism? The wealth is accumulated during active governance. It's happening while the massive decisions are actually being made, often through foreign funds or crypto assets where the origins can be a bit murky. So the big shift isn't really the amount of money. It's the when and from whom. Section 5. Trust in the financial system. So why does this matter to us? Well, this privileged access has a massive impact on our everyday trust in the global financial system. When the playing field looks this wildly uneven, regular retail investors start wondering if the whole game is rigged. And this ties right into that third pillar, prediction markets. For 70 years, the SEC has strictly monitored the traditional stock market. They know exactly how to catch classic insider trading. But the action? It's migrating. These new prediction markets are regulated by the CFTC, an authority that has way less experience hunting down insiders. So if you have inside info, you don't even need to risk buying stocks and getting caught by the SEC anymore. You just move your bet to a brand new market where the referees are basically still figuring out the rules. And this has very real-world consequences. Take platforms like Polymarket. Over $2 billion are wagered there every single week. People aren't just betting on elections, they're betting on micro events, like literally betting on how many times the Fed chairman will say the word tariffs in a speech. The Economist actually noted something super chilling. The odds for Maria Corina Machado winning the Nobel Peace Prize spiked suspiciously in the exact hours before the announcement. I mean, it's as if someone already knew. In these new markets, privileged information has literally never been more valuable. Finally, Section 6, Patience Capitalism. So, what are we supposed to do? If the system rewards insiders who always know things first, how does the everyday person even survive? Well, let's bring this entirely back to you, the retail investor, and what you can actually control. Because your absolute best defense against this insider advantage is simply the boredom of consistency. Seriously, you cannot outtrade people who are dining with CEOs in Beijing. You just don't have their access. Trying to guess the next move of the powerful or chasing a stock the day a politician mentions it, that is a losing game. The real defense is building wealth quietly through well-diversified ETFs and steady accumulation plans. Look at these two approaches side by side. Access capitalism relies on secrets, exclusive relationships, and this frantic need to always be first. It thrives in the shadows. But patience capitalism? It relies on time, unshakable discipline, and regular everyday compounding. It doesn't need a secret tip from a president. It doesn't need to predict a Nobel Prize winner. It simply harnesses the unstoppable, deeply democratic force of time. Which brings us to a final thought to wrap up this explainer. The insiders? They are banking on you not understanding how their game works. They're hoping you'll try to play by their rules and inevitably lose. So I'll leave you with this question to think about. Will you exhaust yourself chasing the impossible advantage of the insiders, or will you build true, lasting wealth by trusting the quiet, unstoppable discipline of time? The choice of which capitalism you participate in is entirely up to you. Thanks so much for joining me for this explainer. Keep learning, and I'll catch you next time.